They call it a first world country. High GDP, AA credit rating, world-class corporations, stock indices flirting with record highs, foreign investors nodding politely at spreadsheets. Now close the spreadsheet. Look at daily life. Look at the worker waking up before sunrise in a shrinking apartment he will never own. Look at the salary that hasn't moved in 20 years. Look at the grocery receipt where protein quietly disappears line by line. Look at the commuter train where silence isn't discipline, it's exhaustion. This is the contradiction nobody in finance brochures wants to explain. On paper, this country is rich. In reality, its people are broke. And this isn't an accident. It's a design choice. The financial illusion. Let's start where advertisers love to start, the stock market. Yes, equities are up. Yes, corporate profits look healthy. Yes, foreign funds keep flowing in. Why? Because labor is cheap. Because wages are frozen. Because households absorb inflation while corporations hoard cash. When companies don't raise salaries, margins expand. When workers can't negotiate, EPS looks beautiful. When domestic consumption weakens, exports get cheaper. This is paradise for capital. It's hell for humans. Investors see a stable market. Workers feel a collapsing floor. That gap is the real story. Real estate, the great psychological scam. Now let's talk property, the favourite asset class of every middle-class dream. Home ownership used to mean stability. Now it means lifetime debt or permanent exclusion. Prices don't crash because the market is strong. They don't rise enough to build wealth either. Instead, housing becomes a psychological prison. Rent forever, save nothing, fear everything. Foreign buyers park money safely. Institutions flip portfolios. REITs perform nicely. Meanwhile, locals live smaller, later, lonelier lives. The country isn't poor. Its people are deliberately kept asset poor. Money flow direction matters. Here's the rule they never say out loud. Money no longer circulates downward. It only flows upward and outward. Wages go in. Debt comes out. Taxes go in. Public services shrink. Corporate reserves balloon. Internal savings sit idle on balance sheets. Households run on credit cards and anxiety. This is not advanced capitalism. This is extraction with good branding. Why this still gets marketed as first world? Because airports are clean, because trains run on time, because numbers look civilized. But civilization is not infrastructure, it's purchasing power, it's time, it's dignity. When a society forces its middle class to live like a risk buffer for corporations and governments, labels stop meaning anything. You can call it first world. Daily life already feels third world, and this is just the opening act. Here's the uncomfortable truth they bury under words like stability and maturity. Global capital does not hate poverty, it hates unpredictability, and nothing is more predictable than a population that accepts low wages, avoids confrontation, fears unemployment more than exploitation. This is why money keeps coming in while people keep falling behind. Cheap humans are the ultimate asset. In finance, every asset has a cost structure. Labor used to be expensive. Now it's been optimized. When wages stagnate for decades, labor becomes a fixed cost input. No surprises, no bargaining, no volatility. For investors, that's gold. Factories stay profitable. Service industries scale quietly. Margins widen without innovation. The people don't complain because they've been trained not to. Silence is priced in. Stock market strength is not a sign of health. Let's kill one myth immediately. A strong stock market does not mean a strong society. It often means the opposite. Stocks rise when payroll growth is suppressed, full-time jobs are replaced with contract labor, benefits disappear without triggering riots, investors reward efficiency. Efficiency punishes humans. Every time wages fail to keep up with inflation, shareholder value improves. Every time households tighten belts, balance sheets loosen. This isn't corruption, it's accounting. The foreign money playbook. Foreign capital doesn't come to build lives, it comes to park money safely and extract yield. Real estate becomes storage, not shelter. Stocks become cash machines, not growth engines. Currencies become tools, not reflections of living standards. As long as courts work, police function, workers stay obedient, money stays. Quality of life is irrelevant. Why governments quietly support this? Because this system is politically convenient. Raising wages risks inflation. Inflation angers bond markets. Bond markets punish governments. So instead, governments praise corporate competitiveness. Central banks protect asset prices. Workers are told to be patient. Patience becomes policy. The population absorbs shock after shock, while leaders celebrate market confidence. Third world living with first world discipline. This is the final twist. In actual developing countries, people resist. They protest. They strike. They break things. Here, people internalize failure. They work harder, sleep less, eat cheaper, blame themselves. That's why capital feels safe. You don't need repression when people self-regulate their suffering. This isn't decay, it's optimization, and it only gets worse from here. Let's stop lying. Housing didn't suddenly become scarce. Land didn't magically disappear. Construction didn't forget how to build. What changed is who housing is for. It's no longer for living, it's for balance sheets. From shelter to financial instrument. Real estate used to be boring. That's why normal people could own it. Then finance touched it. Now homes are yield products, inflation hedges, portfolio diversifiers, parking lots for idle capital. Once housing becomes an asset class, residents become liabilities. If people can't afford to buy, rents go up. If rents go up, returns improve. If returns improve, prices get justified. It's a closed loop that feeds on human delay. Marriage later, children later, ownership never. The generational asset lockout. Older generations bought with one income. Stable jobs, low price to income ratios. Younger generations face dual incomes, contract work, prices divorced from wages. This is not a cycle, it's a lockout. They didn't arrive late, the door was intentionally narrowed, and governments helped. Tax incentives protect owners. Zoning protects scarcity. Low interest rates protect asset values. Everyone wins except the people who need a place to live. Why rents must rise forever. Here's the quiet math no politician wants to explain. If wages don't rise, rents must. Why? Because pension funds need yield, REITs need dividends, insurance companies need stable cash flow, and housing is the safest extraction point. You can delay buying stocks. You can avoid luxury goods. You cannot avoid shelter. Rent becomes a tax paid to capital. A monthly reminder that you exist to service someone else's asset. The psychological damage is the feature. This system doesn't just extract money, it extracts ambition. When people believe they'll never own, they'll never catch up, they'll never rest, they stop planning long-term. Short-term survival replaces future thinking. That's perfect for the system. Desperate people don't unionize, tired people don't revolt, renters don't threaten property values. Hopelessness is market stability. Why this still gets defended? Because asset owners vote, renters wait, because numbers look fine, because indexes are green, because foreign money hasn't left, the suffering is diffuse, the profits are concentrated, and concentration always wins, until it doesn't. 30 years. That's not a slowdown. That's not a cycle. That's a policy outcome. When wages stay flat for decades while productivity, prices, and profits move, something is being managed, and it isn't labour. The great wage freeze workers were told the story gently. Be patient. Protect competitiveness. Think long-term. So they did. Meanwhile, corporate profits rose, executive pay floated upward, internal reserves piled up. The money didn't vanish, it just stopped flowing downward. Wages weren't linked to output anymore. They were linked to fear. Fear of layoffs, fear of replacement, fear of being labelled difficult. A compliant workforce is cheaper than automation. Inflation as a transfer tool. Here's the trick. When inflation hits and wages don't rise, that gap is not neutral. It's a transfer. From households to corporations, savers to asset holders, workers to shareholders. Every price increase without wage adjustment is a silent pay cut. Governments blamed global conditions. Companies blamed cost pressures. Central banks blamed expectations. Nobody blamed design. Why stock markets loved this era? Flat wages are a dream scenario for equities. Costs are predictable, margins are defendable, labour risk disappears, EPS rises without innovation, PR looks attractive, cash piles up. Investors cheer discipline, workers absorb discipline instead. The stock chart goes up, life expectancy goes down. The middle class was not shrinking, it was removed. Middle classes require wage growth, asset access, time security. Remove anyone and the structure cracks. Remove all three and it collapses. The result is visible. Working poor with degrees dual income households, barely surviving elderly working past dignity. This is not decay, it's redistribution without consent. Why this can't continue forever? Here's the ending problem. You can't extract from nothing indefinitely. When households are maxed out, consumption weakens, birth rates collapse, social trust erodes. At that point, capital stops seeing opportunity and starts seeing risk. Money is loyal to returns, not nations, and when it leaves fast. Here's the ending. Nobody markets. You can run a country like a balance sheet for a long time, you just can't do it forever. Eventually, the numbers stop lying for you. The final stage, extraction without renewal. This model works only under one condition. There must always be something left to extract. But look around. Households are tapped out, savings are gone, birth rates are collapsing, young people are opting out quietly. When people stop forming families, buying homes and planning futures, the economy isn't stabilizing, it's hollowing out. At that point, GDP becomes a performance metric, not a reality. Capital is not loyal. This is the part governments pretend not to understand. Capital does not love culture. It does not respect history. It does not care about first world labels. Capital stays while returns are easy and risk is low. The moment. Demographics flip. Consumption weakens structurally. Social tension threatens predictability. Money leaves. Not dramatically, not emotionally. It just reallocates. What happens after the exit? When capital leaves, the illusion collapses fast. Asset prices stop floating. Real estate loses its floor. Pensions start sweating, currencies get nervous, and suddenly, everything that was efficient becomes fragile. The same people who were told to endure now get blamed for not spending enough. The same workers who carried the system are asked to save it. They won't, because there's nothing left to give. First world status is not permanent. This is the lie that did the most damage. Being developed is not a trophy you keep forever. It's a condition you maintain. Once daily life starts resembling scarcity, insecurity, and exhaustion, labels stop working. You can't eat credit ratings, you can't live in stock charts, you can't raise children on macro stability. When daily life collapses, the country follows. Slowly, then all at once. The quiet conclusion. Nobody wants to say this wasn't mismanagement. It wasn't bad luck. It wasn't inevitable, it was a choice. To protect capital over citizens, to freeze wages instead of profits, to monetize housing instead of living, to call silence stability. So yes, first world country, third world daily life. That question mark at the end. It doesn't belong there anymore.